Good afternoon, ladies and gentlemen. Welcome back to this weekly market review. As usual, I have my handsome co-host here, Mr. Gerald, back again, which I finally had the chance to meet in person last Friday. Gerald, how are you? Are your legs feeling okay? Mine is not. I'm not feeling my legs right now.
Yeah, so Sunny and I were at the SGX Book Charge Run on Friday. Effectively, I had to spend the whole of the weekend recovering. So I think the Friday runs would not be something that we'll be doing too often from now on.
Yes. I'm also recovering myself. My legs are still feeling very jelly right now. But then we have a very busy week ahead. We are looking at the ISM manufacturing PMI coming out. Of course, we also have the FOMC rate decision as well as the statement that we will be looking out for. Of course, we also have the non-farm payroll coming in. So a very busy week on the data front, as well as on the earnings front as well. We have McDonald's, we have AMD, Apple, Starbucks, all going to report this week as well on their quarterly results. So will you be covering some of that for us, Gerald, today?
Okay, so let me start by doing a bit of a recap before we go into what's happening this week, because actually last week we already had a fairly busy week in terms of earnings as well as macro data. So as usual, today's sharing is for education and information purposes only. While we are going to be talking about single stocks, they should not be taken to be financial advice. We also have the monthly SIAS that's coming up on the 15th of November. So if you have more detailed questions, do join this event that is exclusively for SIAS member. If you find today's session helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, this is the link to go to. The membership just costs $1 per month. So that is something that will allow you to enjoy different benefits, such as the SIAS program, where you'll be able to ask Sunny and I individual questions. Okay, so let's go into what happened to the market in the past week. We saw that the global stocks actually declined further, with the S&P 500 down about 2.5%, the Nasdaq actually faring worse, down 2.6%. Closer to home, the STI continued to slide, now actually close to the 3,000 mark after it declined 0.5% last week. Okay, so quite a number of different factors that are driving this weakness. But what we saw the market being most concerned about would be the earnings that were reported by a number of large US stocks. Okay, so what we saw here would be number one, Facebook's parent Meta. You see this very sharp decline last week, and effectively what they have told investors is that with the macroeconomic uncertainty, it could lead to lower advertising demand. Okay, so that is the first warning sign that made investors sit up and think that, okay, maybe with this ongoing Middle East conflict, we might actually see more macro uncertainty, and companies are already starting to warn that things may not be as rosy going into the fourth quarter. Okay, so that's the first warning sign by Meta. Next, we also saw Google's parent Alphabet effectively once again having this very sharp fall last week after they reported disappointing performance for its cloud business. Okay, so with the earnings by Meta as well as Alphabet, I think what investors have realized is that even for some of these large US tech stocks, it is not actually as smooth sailing as what some of them might have expected them to be. And the market is effectively reflecting this earnings weakness. Okay, so that is effectively what investors have taken away from the results report. We also see different movements within the macro indicators. First, we have been looking at very closely for the US government bond yields, which has been on this upward trend since the middle of this year. At some point in the previous week, we saw that it actually reached 5%, which was once again a very important indicator for investors. What we saw last week is that it came down slightly to 4.8%, because with the weaker earnings reported by the corporates, there are now concerns that, okay, maybe the economic landscape is not as rosy as what was previously hoped for. And with that, we might potentially see a recession. And the US government bond yields have come down in line with this growing expectation. Okay, we also have the FOMC meeting that is coming up this week on the 1st of November. And at this point in time, most investors are expecting that the Fed will not be raising interest rates further. So effectively, you see a 99.9% chance that they will keep interest rates at 5.25 to 5.5%. Okay, so effectively, with the uncertainty that is going around, with the bond yields already having gone up so much, the expectation is that the Fed will not have to raise interest rates further to be able to bring down inflation. So that is what we see on the macro indicators. If we move closer to home, we actually saw mixed performance within the Singapore stocks. So for example, we saw Genting Singapore gaining by 4.2% last week, Wilmar up by 2.3%, Yangzijiang up by 2.1%. And interestingly, some of the REITs starting to recover slightly. So CICT up by 1.8%, Mapletree Pan Asia Commercial Trust 1.6%. Part of it is driven by the moderation in the 10-year US government bond yields in the past week, but we also saw these two REITs reporting their operational updates that we'll go through in more detail later. Okay, in terms of top losers, we see a number of stocks that are exposed to the Chinese market. So Hong Kong Land actually falling by more than 6%, DFI Retail Group also declining by more than 5%, and then CapitaLand Investment down by close to 5%. Okay, so we see the commonality here in that they all have got sizable China exposure. And I think there is continued concerns about weakness in the Chinese economy that is impacting sentiment towards these stocks. Okay, so what we see in Singapore is companies are also in the midst of the results season. And we saw quite a number of companies and REITs reporting in the past week. So first and foremost, UOB core net profit of 1.48 billion in the third quarter, which is 5% higher compared to the previous year. We saw earlier the rebound in the share price of CICT as well as Mapletree Pan Asia Commercial Trust. For Mapletree Pan Asia Commercial Trust, the distribution per unit fell further to 2.24 cents for the second quarter of its fiscal year 2023-24, which is effectively the quarter ending September 2023. And this would represent an 8% decline compared to the previous year. For CICT, what we saw is that the net property income actually grew by 0.6% in the third quarter compared to the previous year. So we'll go through in more detail around this company results. Okay, so we start by looking at UOB, and what we see here is that the share price has effectively come off since August of this year. At some point, it was above $30, but then it is now at $27 per share. The market didn't seem to take the earnings very well at the same time, and the share price actually continued to decline over the past week. Okay, so what we see here is that the core net profit was actually higher by about 5% year on year. And this was actually driven by quite a number of different factors, especially the fee income that was particularly strong. Okay, so what was the market actually disappointed by? If you look at the net interest margin, it actually came down compared to the last few quarters. The net interest margin in the third quarter was at 2.09%, and that is effectively lower than what we saw in the second quarter, which was at 2.12%, and in the first quarter, which was at 2.14%. Okay, so we have effectively seen a weakening in the net interest margin, which is impacting investor sentiment towards UOB. But what was positive for UOB's results is the net fee income was very strong. In the third quarter, it was at 591 million. And effectively, a lot of this was driven by credit card. If you look at it in the third quarter, the fee income from credit cards was 104 million, which was a sharp increase compared to the previous quarter of 72 million. Okay. So if you recall what happened in the past quarter, we also saw the Taylor Swift concert and also how many people were scrambling to get UOB credit cards to be able to get priority into ordering the Taylor Swift concert tickets. So that has actually led to higher credit card fee income for UOB. Okay, so at this point in time, if we were to look at the UOB valuation, price to book about 1.1 times. So even though we have seen the share price coming off slightly, it is still above the historical average of 1 times. Okay, so that is for UOB results. Next, we go into Mapletree Pan Asia Commercial Trust, a name that we get asked about very often because the share price has come down quite a bit over the past few months. Okay, it hit a multi-year low, and with the results that we saw last week, it rebounded slightly, but still very close to the multi-year lows. Okay, so in terms of the key takeaway from the results, if you look at the net property income for the second quarter of the fiscal year FY 23-24, it was actually higher compared to the previous year. So in terms of the property assets, they are still doing fairly well. But what actually impacted the distributions was this very sharp increase in finance costs to about 58 million in the quarter versus 42 million in the previous year. Okay, so once again, we are starting to see how the higher interest rate is starting to impact different companies as well as REITs. So with the higher financing costs, the distribution per unit actually came down 8.2% compared to the previous year. Hey, if you look at the portfolio, actually the rental reversions remain healthy, especially around the Singapore assets. So if you look at VivoCity, it was able to achieve positive rental reversions of 14%. So what was slightly weaker is the portfolio performance of its Hong Kong and China properties, where if you look at Festival Walk in Hong Kong, the rental reversions was negative 9.5%. But despite the weakness in the Hong Kong and China properties, Mapletree Pan Asia Commercial Trust was still able to achieve an overall portfolio rental reversion of positive 3.2%. Okay, what we see here is the Mapletree Pan Asia Commercial Trust valuation. We saw that the share price has been very weak over the past few months. So with that, the price to book ratio is at about 0.72 times, which is way below the historical average and back to its low somewhere around 2016. Okay, so effectively the share has come off fairly sharply as a reflection of the decline in the distributions per unit. Next, we look at CapitaLand Integrated Commercial Trust. And once again, we see the share price has been weak since August of this year as the 10-year US government bond yield moves up. But once again, there was a bit of a slight bounce after its update last week. Okay, in terms of the net property income, we saw that it was able to increase by 0.6% in the third quarter compared to the previous year. And this was actually driven by better performance amongst its integrated developments. Okay, so you see this improvement in the net property income of its integrated developments, even though we saw that the retail as well as office assets had a slight decline in terms of the NPI. Okay, so in terms of the committed occupancy, we saw an improvement in the third quarter, whether is it in the retail, office, or integrated development assets. And as a result, the portfolio occupancy actually increased to 97.3% from 96.7% in the previous quarter. Okay, so earlier we saw the valuation of Mapletree Pan Asia Commercial Trust, which is close to the 2017 low levels. But for CICT, the valuation is below the historical average at 0.8 times now, but it's still not near where it was at the low during the COVID period. Okay, so we have seen quite a number of different developments in the past week on both the macro and the earnings front. It is going to be equally busy this week, where we continue to see a lot of Singapore companies reporting their results. In the US, we've got Apple reporting results on Thursday as well, so that's going to be closely watched. On top of that, we have got different central bank rate decisions, starting from the Bank of Japan on Tuesday. Then we go into the FOMC meeting and decision on Wednesday, 1st of November. Lastly, we'll end the week with a macro data, which is the US non-farm payroll data, which investors are going to be looking out very closely for as well. Okay, so quite a number of different things that are happening. And I'll pass over to Sunny, who will share with us what does this actually mean from a technical analysis perspective. Over to you, Sunny.
Okay, thanks, Gerald, for the detailed sharing on the earnings last week for some of our Singapore companies. So let's see now how those action reflected on the STI index. So first thing first, the STI index, we talked about the support zone somewhere around this orange highlighted lines over here previously, around the 3,155 points to the 3,100 point level. We have significantly broke below that level already. So we are talking about once we come into this support zone, we need to look for some of the indication of oversold signal, as well as the weakening of the downtrend momentum that we have observed since the peak on 31st of July this year. So you can see that the STI now, the RSI last week, we talked about on Monday, it has actually dipped below the 30-point oversold mark, and then the lowest reading was 27. Today, we are still reading that the RSI latest reading is at 29, so still 1 point below the 30-point mark, which means that the STI index, according to the RSI indicator, is in the oversold territory right now. On the indicators, one of the conditions that we spoke about was for the MACD to show signs of the downtrend momentum actually starting to subside. And we actually see that in the past 5 trading sessions already, where you can see the MACD histogram starting to fade into the background, as well as the convergence of the MACD line towards the signal line. So these are the 2 conditions that I set personally for my own trading. So first thing first, RSI needs to be to trigger the oversold signal below the 30-point mark, and the MACD needs to show the downtrend momentum subsiding. Both of them has been fulfilled, and I feel that this may be the right time, in my opinion, that to get into the STI index. The next question then is at which level? But before I go into which level to look at, I just want to know that just want to let you know somewhere in history in August, where we have a RSI low reading of 29 as well. That's on 21st of August over here. You can see that the STI actually do have a bounce over here. Now, the position or the long position that I may be taking, I'm not saying that the STI is likely, it may go on a uptrend or on the long term already. But as of now, I know that this may be a support level that we may be looking at. And the indicators are telling me that the conditions are satisfied to go in to take a long position. This could be a rebound, a counter trend move towards the downtrend that we are looking at since the peak in July. Even if this is a counter trend move, I think that the level over here that we have about the 3,050 points level, if we are able to push up to the 20 days moving average, which is sloping downwards right now, the black color line, which is also the Bollinger Band basis at 3,133 points, this could be some kind of a margin that traders can play with. Okay, but as of now, I do not know whether the STI downtrend since the peak of July is going to have a rebound and retest the year-to-date high. That we cannot say for now, but as of now, this support level can move into a sideways direction, but we will need to assess the indicators and the information when we reach the level on the 20 days moving average. So what is the support level that I'm talking about? So I'm going to pull back my chart into history a little bit. So we have broke the year-to-date low previously set in March this year. We also look at the June low last year around the 3,060 points level, which was also broken down, especially today on Monday, where I see that when the market opened on the STI, it's down about 0.5% or 13 points. We are now going into the level of this level over here, which is the 21st December low. And this will be the support level that we are looking at around the 333 points level, which is where we could be touching today on the low side. The low today is still 3,041 points. So we are very close over there, about 9 or 10 points away. And both conditions have been met. And I think this level is somewhere a level that I will be getting into for the SCI index to target the 20 days moving average at 3133. Okay, next, let's move to the major US indices. So let's touch on the Dow Jones Index first. Last Friday, it was down 1.12%, about 366 points drop. We can see that we are using the support on the 25th May low, which is around the level of 32,586 points level for a support. We closed below that, so it's still unclear whether this support is likely to hold. If this is unable to hold, then we will look a little bit further back in history, which is in March this year, and that's the year-to-date low on the Dow Jones Index at 31429. According to the technical indicators, the conditions, the MACD is saying that the downside momentum or the downside trend that we are seeing now has not shown any signs of subsiding. So it is still looking like the MACD line, which is the black line, is still diverging away from the signal line, hence signaling to us that the downtrend on the Dow Jones Index has not subsided yet and may continue to sort of exacerbate and go down further, and that would mean that we may retest the year-to-date low. The chance of testing the year-to-date low is actually pretty high, I would say, and around this level of 32,200, we also have a bounce last year in the February period. Okay, so will the February period support level hold for the Dow Jones Index? I do not have the confirmation for both of the indicators, and both of them have not satisfied my condition. At least for the MACD, that has not satisfied the condition of the first sign of a subsiding of the downtrend momentum. But the RSI did cross the oversold level of 30 points. So that is just half of the equation. So we have a confirmation that the Dow Jones Index from the RSI is oversold right now, but we do not see the downside momentum subsiding yet for the Dow Jones Index according to the MACD indicator. So I would just be a little bit more patient and wait for the second conditions in my trading strategy to come in to confirm before I decide whether the 32,200 level is a good time to get in, or we have to be a bit more patient to wait for the year-to-date low at 31,400 level. That's the Dow Jones Index. Next, let's move to the S&P 500. So S&P 500 down about 0.48% last Friday on 19 points. We are using the May low as well over here, this line over here, this support level over here at 4114 as the support for the S&P 500 index. So last Friday, we are just resting 3 points above this level of 4114. Now, resistance level to watch out for, I will not touch on the resistance yet. Maybe the 20 days moving average might be the one that we should be looking at. But for now, the MACD indicator, similar to the Dow Jones Index, still has not shown any signs of subsiding in the downside momentum that we observed since the peak in July this year. So if let's say we were to break this support level of 4114, which is somewhere the support in May, as well as you can also see over here is the double top formation in November and December last year as well. If this level is unable to hold, I think we will really be looking at the year-to-date low at 3,800 points level. So for now, I don't think I am confident in the S&P 500. Because the indicators, the MACD indicators is still not showing signs, as well as if let's say we were to break this support level of 3114, we could be going into a very steep drops towards the year-to-date low at 3,800 points. So this is actually a very risky move to go long for the S&P 500 going into the next few weeks towards the end of the year. So Dow Jones Index would be a more conservative and safer bet compared to the S&P 500 right now. Next, let's move to the even more volatile tech-heavy NASDAQ Composite Index. So we have a positive Friday, interestingly, for the NASDAQ Composite Index. So that means some of the tech stocks may be doing well, for example, Microsoft, but that cannot be said for Google as well as Facebook, which is a Meta Platform, and Alphabet. So we have a close to a 1% gain last Friday on the NASDAQ Composite Index, up about 123 points. we will be looking at the support level of, let me see. Okay, over here, this green color line over here, which is the low, which is a double bottom formation somewhere in the February and March period of last year. So a double bottom is a sort of a strong kind of support in a technical perspective for a rebound to happen. So I think that may be that may be one of the reasons for last Friday bounce as well on the Nasdaq Composite Index. So this level of 12,555 points is giving some support to the Nasdaq Composite Index as of last week. Also on the MACD indicator for the Nasdaq Composite Index, still no signs that the downside momentum or the downtrend that we observed since the peak in July is subsiding, and that means that one of the conditions is not fulfilled yet for us to make the decision to go long. And on the RSI, the reading now is at 35. The lowest that we went to last Thursday was 30.99. So have not triggered the oversold signal as well. But then the levels on the RSI, whether we say that it's 30, it's 25, some of you may ask, it's not that it's subjective, but we need to look at in history, how does it behave at the level? So for example, last Thursday low at 30.99, you can see that somewhere in the September period as well, where we reached the 31 point level. And of course, in the August period, where we reached the 32 points level, we do see a bounce on the Nasdaq Composite Index. Like I said, this may be a counter trend. We may have started the downtrend already. We may not know yet, but this may be a counter trend with some margins for traders to trade on once it satisfies the condition that we are close to the oversold trigger of 30 points, and we start seeing a subsiding of the momentum in the MACD indicator. That may be a good time to get back in, although it may be a counter trend to take a bit of a profit from the market before we then reassess those points that whether the uptrend is going to continue into a long-term trend or it may just be a counter trend move for now. So that's all I have for the major indices this week. Any final comments, Gerald?
So I think we have been looking at some of the technical indicators, some of them close to the support levels, and I think quite a number of different things that we need to be looking out for the market as well. Whether is it the macro updates, the Federal Reserve meeting, or the upcoming earnings report by different companies and REITs. So for investors, we need to be looking out closely for some of these indicators and make sure that we make the right investment decisions accordingly.
Yes, totally agree with Gerald. As an investor, as a trader, we want to have all the tools available for us to make the most informed decision for our trading and investment. So thank you once again, Gerald, for joining us today. We hope that you do find the content useful and do consider giving Gerald and ourselves a like or a share on the platform that you're watching on. And we hope to catch you again next week, same time, same place at our weekly market review. Okay, signing off for now.
Thank you.